So what is Roaring Kitty and what has it got to do with GameStop? Well, if you know, you know, but if you don't, stick around this week. We're going to talk about that here on Retirement Approved with the brothers Paul. Don't go anywhere. Hey, everybody, welcome into the podcast once again here with Matt and Steve. Paul, going to talk investing, finance, and retirement, and we're going to get into some some of the news of the day, or well, with the news of the month, I suppose, last couple of weeks here, some things going on. And we're going to talk to the guys about what's been happening with the GameStop thing yet again, and CPI numbers and all sorts of good stuff. So we'll just dive right in and get started. What's going on, Steve? How are you, my friend?
Hey, I'm hanging in there. How you doing?
Doing pretty good. Looking forward to talking about this today. I was familiar with the GameStop thing. I wasn't familiar with the Roaring Kitty. So I'll be, excited to have Matt explain that to us, as I'm sure Matt's going to probably do, or you, either one, whoever wants to tackle it. But first, Matt, how are you, my friend?
I'm doing great.
Doing good? Doing good? Very good. Nice to see you guys. Good to hang out with you. All right. So whoever wants to tackle it, hit me with it. Hit us with it. What is Roaring Kitty?
Our clients have got to be like, what is going on? What the heck is Roaring Kitty? So you remember with Wall Street Bets, the group that took on the hedge funds, and the hedge funds were shorting GameStop, and Roaring Kitty comes out and says, I love the stock, and they just bid it up and bought it like crazy.
Oh, okay.
The hedge funds had some major issues. Well, Roaring Kitty, I'm going to call him Keith Gill because I just can't keep saying Roaring Kitty. Keith Gill
so
is back.
It's a person's like online thing, right?
Yes. His Twitter handle, his YouTube handle. So Keith Gill is back. And now we're getting some questions. Hey, we missed out on GameStop last time and this run that it went on. Should we get into it this go around? My answer is still no.
It's a tough stock to buy at this point. It's a company that sells video games, but no one buys video games at the store anymore. They all download them on their Xbox or their PlayStation. So
exactly, they've actually turned into kind of a toy store. They're almost kind of going back to years ago. They merged with KB Toys a long time ago, and they're almost going back to that. They've got like toys and all sorts of stuff in there now. Just because, to your point, I don't think everybody just downloads them now, right?
Mm-hmm. Yeah, and I mean, it's a great story. It made for a great movie. Did either of you see the movie Dumb Money?
Yeah, it was interesting.
Seth Rogen, Paul Dano. It was a great movie. It's a great story.
Paul Dano's fantastic. Yeah,
very entertaining. Don't buy the stock. I don't like the stock. I'm intrigued by the stock. Let me say that because of all the shares they issued and the mountain of cash that they're sitting on. I think they're 5 billion in cash.
5 billion. Yeah, because what happened is Roaring Kitty came back. He bought a ton of out of the money options. He bought a ton of the stock somehow, like way more than you're like, how does he even have this much money? And he did this live stream. So Steve and I actually blocked a half an hour of our schedule off. We're like, let's tune in, see what he has to say. So I bought one share and we sat down to watch this, and Roaring Kitty's a half an hour late for the stream. So then he finally comes on. He's got Band-Aids everywhere, and he's a total mess, I would say, is an understatement.
Classic Roaring Kitty fashion, yeah.
Okay, all right.
He's actually a very intelligent investor. He's made a ton of money. It's one of those things where we're younger investors. So I think some of our clients have heard from their grandkids, get into GameStop this time. It could go parabolic again. You could make a bunch of money. You want to throw a few $100 in with your grandkid, go ahead and do that. But this isn't something that we're adding to our models at this point. We don't believe in it long term. We're intrigued by it. I want to see what the CEO does with this $5 billion, what direction they go in. But it's certainly not something you want to throw a big chunk of your portfolio in.
Gotcha. Yeah, and the last result, Roaring Kitty turned, I think it was $50,000 into $50 million. This go didn't do as well for him yet. Who knows? Maybe there's more yet to come. But he was on paper at one point after hours when the stock was going crazy and people were buying in. He almost became a billionaire on paper, but he would have never been able to sell that stock, and he would have had to pay taxes on it as well. So, but the stock came cratering down as expected, and GameStop actually issued a lot more shares and kind of took advantage of the situation. And now that's why they're sitting on $5 billion in cash to figure out their next move. So I guess Mr. Kitty is expecting GameStop to pull something off and do some sort of pivot with their business model. We'll see, though.
You wonder if Mr. Kitty's intrigued at all by what was the dog? What was the dog thing we talked about a few weeks ago?
Oh God, yeah.
Oh, dog with that. we like to start the show off with complete silliness. This is it's so ridiculous.
Well, Doge has the dog, but then there was that other one. Now I can't even remember what we were talking about.
Dog with hat. Yep.
Yeah.
Oh, dog with hat. That's right. Yeah.
Yep.
So you've got Kitty, a kitty that roars and a dog with a hat. They should totally do a live stream or a YouTube channel, and you never know what might happen.
Finance now. Apparently, it's just a whole bunch of meme stocks and meme coins. But
well, look, Mr. Kitty, if you decide to do that, I just want to get credit for the idea. Let me host it, something like that. Anyway, all right, moving on.
We need to hurry up and get to inflation before people start turning off our show.
Exactly. I was going to say, let's just go ahead and get into the inflation. But I mean, it was a good point to bring up because it is kind of salacious, right? People did make a lot of money that go around. They were very intrigued by the story, Steve, to your point. So, people were asking questions. Hey, what is this? Should I take a look at it? So that's one of the reasons we wanted to include it in the show. But all right, Matt, hit us with some inflation, bud.
So good news on inflation. So we've talked on the show before how this is going to be a slow process. We've got a lot of sticky numbers that are baked into that inflation number, and it's going to take a lot of patience. And we saw that first, I'll say CPI beat where the numbers came in lower than expected in May, which is phenomenal news. And the Fed is going to continue to be data dependent, which means going forward, they want to see that number keep coming down and down and down, closer to that 2% number as they get more comfortable to potentially start lowering rates.
They really like that 2% number. And I mean, we've seen Canada cut rates, ECB cut rates. So the Fed's walking a fine line here. I mean, you look at consumer savings, that's down. Credit card debt is starting to inch up now. So they're really walking a fine line. They need to be careful here. And that's why we're telling clients, over the next few months here, we could see some chop. We could see some volatility before we see that first cut, which could come this fall.
Yep. And I'm going to say probably after the election because the Fed wants to appear like they're not influenced by politics or anything like that. But who knows? Maybe they'll get enough pressure from.
I'm going to go before.
Okay.
I'm going to go before. I think they're going to get that pressure from the Biden administration. Nobody wants a poor market volatility going into the election.
That's true.
So I think they're going to cut before. We're on record. So we got a bet going here.
All right. We'll bet a beer.
Yeah, that's a great point, Steve, because people tend to normally vote their wallet, right? And obviously right now we've got a lot of stuff going on. You were talking about, just in general with the inflation and the cuts and so on and so forth, and talking about credit card debt or just in debt in general. At the time we're taping this particular podcast, household debts climbed to $17.69 trillion in the first quarter, and credit card debts hovering around $1.05 trillion. So, people they're having to spend money where, to get by, I guess, because of inflation, right?
Nobody's complaining too much yet because the market keeps just chugging along. I mean, we're all complaining about what we're spending on eggs, but we haven't felt it in our portfolio yet. And once that happens, that's going to be a major issue.
Well, if you got the space, you got some chickens, you got some, put some chickens out back and you're good to go. That'll help a lot. All right. Hit me with the next thing here. What do we got? ETFs?
Oh, you know where we're going with this, right?
Where are we going?
Come on.
Ethereum?
Go to crypto. You know we're going to Ethereum.
We're going to Ethereum.
So I would say after Roaring Kitty, the most questions we've been getting now is on Ethereum and the ETFs. So we saw the Bitcoin ETFs approved, and then the SEC really pivoted. It looked like they were not going to approve the ETH ETFs, and they have approved them now. And we just saw Van Eck come out with a report with some pretty interesting price targets on it.
Yeah. So there's a lot of ETF providers now. We've got BlackRock, Van Eck's one of them, like you said, Fidelity, ARK, to name a few, Franklin Templeton. And now we're going to see these reports coming on trying to explain Ethereum, what the heck it is, because it doesn't have that easy story that like Bitcoin does. So Bitcoin, you can just say, hey, it's digital gold or a digital pet rock if you're a bear. But Ethereum, there's no saying. You can't say, oh, it's the world computer or program. It's hard to understand what it does. So Van Eck put a great report together. We'll put it in the description, just kind of explaining what Ethereum does, why you'll see why us finance nerds like it. There's a lot of innovation that can disrupt Apple, Google, that kind of stuff. But Van Eck's price targets are interesting to say the least.
And I think Matthew Siegel, who wrote this Ethereum report, very intelligent, and I agree with a lot of what he had to say. But these price targets lead to some issues because as people see them, clients see them and go, okay, I want to get more and more of my portfolio into Ethereum. If it could possibly hit, I think their base case was what, 22,000, and then they see
by 2030, yeah,
by 2030, and then bull case by 2030, 154,000. I mean, you see those price projections. Like, I want to push more, and anything that can go up that fast can also go down that fast.
Sure. Now, are you talking about in the ETF version, not just like straight, through the crypto exchange, right?
So the actual Ethereum price, which right now is about
which would be still crypto,
400 as we're recording.
Yeah.
So they're saying, hey, it could go as 154,000, or it could fall to close to zero, 90 some percent to 360. So they're essentially saying somewhere
could go to zero.
Yeah, somewhere between a $40 billion market cap and 15 trillion. So pretty wide range.
Well, it's still the Wild West then.
Exactly. You have to, because we don't know, are there going to be stocks and bonds tokenized by BlackRock and Fidelity, or is it kind of going to be useless technology that nobody ends up using? That's the two cases, or somewhere in between.
Speculative asset, so much risk there. I mean, that's why. I mean, I like, if you read further into this report, VanEck talks about incorporating it into a 60-40 portfolio. Maybe going 2%, 4%, 6%. Here's what it looks like. Here's what past returns would have looked like. So we tell our clients, if we're going off a 60-40 model, let's say you have 4 or 5% in silver and gold, tone that down to 2 and throw 2 in Ethereum and Bitcoin if you want that exposure. But really, it's on a case by case basis. I mean, if you've got this bucket over here on our map that you are not touching for the next 20, 30 years, it's probably a wealth transfer bucket geared toward growth. You can put a little bit more in Bitcoin, Ethereum. You can take that type of risk if you want to. But if you need your whole portfolio to cash flow and there's longevity risk on the back end, do not push chips in going, well, if we hit it big, we might be able to live it up on the back end of retirement. Don't take that type of risk, because we don't know where it's going for sure.
Yeah. Gotcha. And one thing I really liked in this report, and we'll throw this chart up, is it looks like an efficient frontier where it's got a bunch of different dots on it. And I'm just going to focus on one dot right now, and that's the green one, which is that bottom left dot, which says it's a 60-40 portfolio with no crypto exposure. So you're going to do about 8.5% return, and that standard deviation is the volatility. So the higher the volatility, the higher fluctuations you're going to see in your account, whether it's to the upside or the downside. So by adding a little bit of crypto exposure, which the purple dots would be, that's going to be some Bitcoin and Ethereum combined, that actually has the effect of elevating the return and increasing the risk. But as you can see, the more crypto you add, the higher the risk, which is obvious at this point, but the returns are justifying it. But the key here is this is the previous 9 years. So yes, we've had a phenomenal run there. What are we going to see over the next decade? And that's something that we're just going to have to wait and see on. If this is
and it really, again, it comes down to age and time horizon. So we have quite a few clients that say, hey, I've got this Roth bucket over here. It's a wealth transfer bucket at this point for me, and they're just looking to add to it on a year-to-year basis, and they're okay with taking a little bit more risk there. So we've seen a little bit more Bitcoin, Ethereum exposure over in that Roth bucket. But again, if you don't have the funds to take that type of risk, if you're entering retirement or early on in retirement, the last thing you want to do is risk your retirement. Especially if you put a plan together and you can generate income, supplement Social Security or pension, and you're in great shape, don't risk that.
All right. So that's this week's conversation on Ethereum, as we tend to talk about quite a bit. So let's transition, guys, and we'll wrap it up this week with the Magnificent Seven. What's going on there in that front?
This is the most important thing that's driving the market right now, and these are the 7 stocks that have dominated for the last 18 months, or you could go 5 years at this point. So they're getting a little boring to talk about at this point, except for one, and that's going to be Nvidia. So if we throw this chart up, you can see Nvidia's absolutely crushed it for about 18 months now. It's been the perfect company. Their last earnings report in May, they did a stock split, they increased guidance, they crushed their earnings, they increased the dividend. How much more perfect can this company get at this point? And that's where we're wondering if it's starting to top.
Well, they did lose their title just a hair, right? They slipped just a hair. They're not the top company again. I think they gave it up, right? But
correct. Yeah, they actually throned Microsoft and Apple for a day or two there at a $3.3
day or
trillion
two.
market cap. But the problem is we're recording this a few days in advance, and it could be well above that in 3 days at this point.
Yeah.
Hey, they got to wear that crown for a little while. So,
Hey.
But I think it's like 1/3 of the S&P's market performance is actually all Nvidia.
Yes, for
Crazy.
2024.
It's
And then
wild, yeah.
if you look at the top 5 companies, so again, that chart, so that's going to be Apple, Microsoft, Google, Amazon, Nvidia, that accounts for 75 to 80% of the gains of the S&P year to date. So if you're sitting in equal weight or a diversified fund or international exposure, that's all holding you back at this point because all the returns are generated by 6 companies.
It's fun. We, as financial advisors, we get to have the fun conversation with clients where it's like, hey, do you see all these positions that have pretty much generated your entire return? Well, we want to start selling some of them now because their P's are off the charts. And we feel there's some very undervalued asset classes and sectors that we want to start buying up. Yeah. I had one client that goes, so you're telling me you want to sell all my cool stuff and buy a bunch of boring stuff? I'm like, yeah, that's exactly what I want to do. I think, Matt, you have a chart kind of illustrating this. Yeah.
Yes. So the Vanguard market outlook chart here. So what Vanguard did was they projected out for the next 10 years where they felt asset classes were going to go. So if you look at U.S. growth, which is going to be these large cap companies, shockingly, Vanguard is thinking that over the next 10 years, they're going to average 2.4% return. When you look at large cap value at 4 to 6 or small cap at 4 to 6 or even bonds at 4 to 5. So that's where we're looking. And we tend to agree with Vanguard at this point. Growth may be a little bit overdone, and it might be time to look at some of these, we call them boomer stocks, that are a little bit more boring. They pay a dividend. Nobody's going to stop going to CVS all of a sudden or stop paying their phone bill at AT&T. They're very nice valued companies, and it's to start increasing the value, the small cap exposure for sure, and just getting more diversified than 5-6 companies.
So one of the hardest things to do as an investor too is go in and trim your winners, especially when you're seeing these types of gains in tech. And it's like, yeah, we want to go in and we want to rebalance. We want to bring it back to the original allocation. We want to sell in tech. We want to buy value. We want to buy up small cap. We want to buy up fixed income, which I think is going to do really well over the next 3 to 5 years, especially when the Fed starts cutting rates and there's far less risk there. So it's hard to make those moves. It's hard to sell your winners, and that's one of the things we're kind of coaching our clients through right now.
And that's the point, right? That's the point of working with financial professionals because, yeah, the sexy stuff always sells, right? Just like in sports or whatever the case is, whatever the thing is going on. But sometimes, it's the traditional stuff that gets it done, right? So, defense wins championships, all that kind of stuff, right? So you still got to think about it that way in terms of, if it's maxed out or it's getting close to maxing out, maybe you need to have some diversity in there. And to the point that the conversation this week, that's where some of that can come in. Anything else before we wrap it up? Any final thoughts there, Matt?
Yeah, and we aren't saying don't own Nvidia, don't own Apple. They're core holdings in all of our models at this point. It's just making sure you're not overexposed. So a lot of people let their S&P or QQQ fund, if they let it ride, and then they end up picking up more Apple, more Nvidia on their own, and it just gets to be 30, 40, 50% of their portfolio and just 5 positions, and that's all going to correlate when what happens.
Sure. Okay. Well, there you go. So hopefully that picked you up a couple of useful nuggets of information along the way this week. As always, if you got some questions, get on the calendar, reach out to the guys and just set up some time to chat with them. Go to retirementapproved.com. That's retirementapproved.com. A lot of good tools, tips, resources there for the podcast. Check out all that good stuff. If you want to call them, we got the number on the screen if you've been watching, or you can just call 248-305-9911. That's 248-305-9911 to get onto the calendar and talk with the team at RW Paul and Associates. Guys, thanks for hanging out as always and breaking it down for us. And Mr. Kitty, just keep me in mind. That's all I'm saying. And after that, we're good to go. Thanks, Steve, for hanging out, bud.
All right. Take care.
We'll see you next time. Thanks, Matt.
Yep.
Have a great week, folks. Don't forget to subscribe to us on Apple, Spotify, and YouTube. And we'll catch you next time here on Retirement Approved.
Retirement Approved is brought to you by Richard W. Paul & Associates, an SEC-registered investment advisory firm. Throughout the presentation, we may generally discuss different financial vehicles. However, nothing we say should be construed as a recommendation to buy or sell any financial vehicle, nor should it be used to make decisions today about your investments or insurance. For full disclosures, check the show notes of today's episode.